Hi, and welcome back to Tim Bingham's Options and Volatility newsletter. We'll be taking a look today at why we think it might finally be time to quote somewhat the late great John Lennon to give puts a chance as the markets close at all-time highs yet again. So let's jump in and take a look at some of the reasons why. First, here is the Fear and Greed Index. Yeah, it's kind of a generic look at the overall fear and greed in the market, but it does actually have some validity as far as market timing. You can see fear and greed did close at the highest level over the past year. Extreme greed at a 78 reading, never closed above 75 back in last October. It was basically chopping around 75 for a while before the market finally gave in and fell sharply. We'll see if that comes to fruition again, but certainly the market getting extremely greedy, which is a sign of complacency as well. Complacency usually equates to a good time to maybe be taking a counter trend position with a bearish put play. We can also take a look at valuations. Here is the valuation from a price to sales basis, right, on the S&P 500 index at an all-time high. This is a all-time high, right? Not just going back a year or so. This is the loftiest price to sales multiple we've ever seen on the S&P 500. Closed at 3.19. Did close a couple times over 3, and we'll take a look, right, what those kind of led to on the chart when we take a look at that. But previous times it closed at basically over 3, led to significant pullbacks in the market. We can take a look on a shorter term basis, and you can see here's the last time, right, which was February of this year, right, the last time of the 2 times only in history that the S&P 500 closed with a greater than 3x multiple, right? That led, again, it was before the Liberation Day sell-off, but nonetheless, the market was certainly getting rather overpriced. So the market getting rich on a valuation basis, price to earnings, free cash flow, all the other indicators certainly at rich valuations as well. And you can see here, record high of 3.187. That's right here, right? The typical range, right, is between basically 2 and 2.5, right? So this has exceeded it to a large degree. A lot of faith being priced in to AI here, certainly going forward. Then we can take a look at the chart. Here again, the only 2 times that we had the price to sales over 3x, right? 3 times, right? Both led to significant pullbacks, right? Back here, we're looking at the market. 475 bottomed out at about 350, right? So a very sharp drop on here, and then slightly over 600 to just under 500 on this pullback that happened rather quickly. So certainly the technicals kind of line up with the overvalued sort of scenario in the market. You can also look straight out at the technicals. We are getting overbought on a RSI basis, right? Bollinger percent B also overbought. Been a very long time since we've dipped below that 20-day moving average as well. Normally the market doesn't stay this elevated for this long, so we'll see how far this one lasts. And then finally, implied volatility, right, starting to curl higher, right? We'll shorten this up and take a look at IV this year, but you can see getting towards the lowest levels of the year. So put prices getting cheap, certainly. So that sets up ideally for the trade as well. And then if you want to take a look at seasonality, the market certainly has, over the past 17 years since the financial crisis, July has been the best performing month, right? And August pretty much flat. September by far the worst performing month. So if we can take a look at that seasonality effect, we can see here it is right here since the financial crisis, right? You can see July has been by far the strongest month, right, over the past 17 years, up basically 9 out of 10 times. But August pretty much flat, only up about half the time. September with an average negative month, right? The only negative month over the past 17 years since the financial crisis that stocks had weakness. So I think this sets up ideally for a trade to take advantage of that, right? Stay out of the way of July for seasonality, but going out to September, buying the 600 puts, which are about 5% out of the money, right? S&P or SPY I like to use just because of liquidity and cost, right? Trading at 625. So buying the 600 put, traditional expiration, selling to hedge it the August 600 put and paying just under $4 for that trade. We're able to do that at basically about a 17 and change vol, certainly under 18. So not a very rich, as far as option pricing. You can see the IV percentile currently at only 15%, which means over the past year, options haven't been this cheap. Except for 15% of the time, with stocks at all-time highs, right? Certainly kind of makes sense, I think, to take a guardedly bearish position for a potential pullback based on the fact that complacency and greed, right, has gotten to an extreme, as witnessed by that, extreme greed, fear and greed getting to the loftiest level of the year. We also see valuations, right, as we talked about, price to sales of 3.19. And even if you look at PE ratio, right, you can take a look and see that PEs are getting to those rich levels as well. The last time we saw this was right before Liberation Day as well. So PE ratios certainly in extremes. And factor in the fact that interest rates, right, are not coming down as fast as they had previously anticipated. So valuation multiples should be lower simply because interest rates are higher, right? Instead, these valuation multiples have expanded in the face of an expanding interest rate environment, right? And yet you can certainly say the Fed is going to be cutting, but it doesn't justify the fact that these multiples are at historic extremes. So hopefully provide some insight into how we go about identifying potential trade opportunities that put the probabilities in your favor, because after all, at the end of the day, trading is about probabilities, not certainties.